Module 1.10, Understanding Leverage and Margin. This critical unit in terms of your understanding has the learning outcomes to understand how leverage and margin work with Forex trading and to recognize the risks associated with leverage and margin and know the actions to manage these. So what is leverage? Well, in basic terms, the definition of leverage is to have the ability to control a large amount of money using a fraction of your own money and essentially borrowing the rest. The most familiar sort of leverage for most people is used in purchasing property, where we have a deposit which constitutes only a small proportion of the value of a house and we borrow the rest from a bank. You have the opportunity in your Forex account to use the same principle. The default leverage on your Forex account is set at 100 to 1, meaning that for every $1 you have in your account, you have buying power of $100 of whichever Forex pair is of interest. If you have $1,000 in your account, therefore, you have a buying power of 100,000 of whatever the base currency is. The impact of leverage is critical to understand. You need to appreciate the opportunity, but always know the risk. The larger position you can enter means that your profits are magnified for the money that you have used as your deposit, if a trade goes in your desired direction, of course. Conversely, and this is the risk, it will also magnify your losses if a trade goes against you. So you need to be absolutely clear that if you mismanage leverage through consistently entering large positions without appropriate risk management exit systems in place, this can result in major capital drawdowns on the money in your account. That is why knowing this is of vital importance to you. So what about margin? Well, we have already discussed the principle of leverage. Margin expresses in dollar and percentage terms how you are using this leverage. Using the previous example in slide 2, to control a $100,000 position, your broker will set aside $1,000 from your account. This is termed the margin requirement and is actioned as soon as you open the position. As discussed, the leverage is now 100 to 1. You're now controlling $100,000 with $1,000. In percentage terms, this margin is expressed as 1%. It may be possible through an application process to apply for a higher leverage level, for example 200 to 1. If you're working with this 200 to 1 leverage level, then your margin requirement is 0.5%. The bottom line is that you'll not be able to open positions unless you have sufficient capital to cover the margin requirement. So therefore, if you want to open $100,000 and don't have $1,000 in your account, the system won't let you open that particular position. Other important margin numbers that you need to know. At the bottom of the screen on your trading platform, you'll see some figures related to margin in your account. We've given you an example here to make it easy for you to find. We're going to go through these one by one so you get complete clarity on what they mean to you. Your balance is your cash balance of your account, excluding your running profit loss from any positions you have open. Whereas your equity is your account value, including your running profit loss from open positions. The margin is the amount of money your broker has locked in as the margin requirement to cover the positions you have open at that particular time. And the free margin is the amount of buying power you have left in your account. The sum related to this is you take your equity and minus your margin that you've already used. Your margin level is your used margin expressed as a percentage. So in other words, equity divided by margin times 100. I hope that helps explain what these figures mean to you, and we're going to go into why these are important as we go through the rest of this unit. But of course, please contact your account manager if anything is unclear. They're there to take your call if you need clarity. So what does this mean in dollar terms? It's important that you understand the maths regarding your exposure and the margin requirement. So an example may be as follows. Let's say you open one standard lot of Euro USD at 100 to 1 leverage. This gives you exposure to 100,000 units of the base currency, in this case the euro, so you have exposure to 100,000 euro. Your margin requirement, therefore, at this leverage level is 1,000 euro. Because your account currency is in Australian dollars, these figures are converted back into Australian dollars. So what this means is that if the current exchange rate of the euro Aussie dollar is at 155, then your account exposure in that position is 155,000 Australian dollars, which will require a margin requirement of 1,550 Australian dollars. So let's start to look at when margin problems occur. This is important again to understand because obviously it's in your interest to manage your account prior to this happening. We've already referenced the fact that you can't open positions if you don't have the required margin in your account. Problems with margin usage tend to occur, firstly, when traders are running close to the maximum margin use, and secondly, open positions subsequently move against them. Let's use an example where you have an allowed 100-to-1 leverage and you are choosing to trade close to your maximum. So let's say in this example we open an Australian dollar US dollar standard lot position with 2,000 Australian dollars in your account. This position has a margin requirement of 1,000 Australian dollars. So you're borrowing essentially, although that's not a term we would use, $99,000 to open this particular position. What this means is that you have 1,000 capital left in your account that is not being used for open positions at this time. So your margin level in this example is 200%. So let's use this example and say that the market moves against you and your $100,000 position drops in value by $2,000. You still have $99,000 owed, but you have now lost your initial $1,000 margin requirement, which has been used to cover the drop in value, and you will have also lost the additional $1,000 that was the capital in your account. However, our systems have a maximum allowed margin level of 50%, and they will intervene prior to this, which we're going to talk about in the next slide. So what will happen? Well, there are times when our systems protect you from extending losses beyond your account value, as we intimated in the last slide. These include blocking a trade that exceeds your allowed leverage. Secondly, sending out a warning message when your margin level is at 80%. You will receive notification of your three options, and this is termed a margin call. You can do nothing and cross your fingers and hope that the market moves for you. You can add equity, i.e. additional funds, and then make decisions on your open positions, or you can reduce your overall position size, i.e. start to close positions yourself. When your margin level falls below 50%, the system will automatically close you out of the biggest losing trade. And of course, from a broader point of view, we'll review any application for leverage above the default 100-to-1. These are the things that we have in place as protective systems. I really can't emphasize this key point enough. Not only is mismanaging leverage a danger to your capital, but also closing positions due to leverage issues is not an effective exit strategy. It completely takes away the control of your trading decisions. You could have perfectly legitimate exit systems in place, but if you've mismanaged your leverage and the system starts to close you out, then that has taken away your control. So what should you do with leverage and margin? First of all, you need to understand completely the risks associated with leverage and how margin works. We do recognize that this is probably for many of you who are starting your Forex trading journey, something that isn't very familiar. But we do emphasize the importance of getting to grips with this. And of course, we're here to help to give you the clarity you need. You need to avoid trading close to your free margin level and know your account value at all times. It is on the bottom of the screen. Just make sure you keep an eye on, particularly if you're close to using your maximum allowed margin. Manage your capital proactively. It may be prudent to have some access to some emergency additional funds already planned. So if you do, for whatever reason, have a margin call, that you can give yourself the breathing space to make the right decisions on the positions you have open, rather than risking the system closing them down. And of course, proactively also have effective money management strategies, including appropriate position sizing for the size of your account, and planning and adhering to exits, as we're going to talk about extensively in Module 3, to control any loss to within your tolerable limits. So for example, 2% of your overall trading capital for any one trade. And just to reinforce that point, don't give away control of your trading. You don't want to be in a position where closing positions is due to leverage mismanagement. So your actions from this unit are, first of all, review this unit again. As I said before, this information is crucial and you must understand the content. Please feel free to give the team a call, as I've suggested before, for any clarity that you need. We'll see you in the next module.